On a quiet morning in early 2025, nothing will look wrong in your neighborhood. Cars will be parked in the driveways. Zillow will still show confident prices. Mortgage payments will still be going through. And that's exactly why this is dangerous. Because the most destructive financial collapses never begin with chaos. They begin with calm. Right now, tens of millions of American homeowners believe they're safe, not because they've checked the math, but because the system hasn't visibly broken yet. That belief is about to be tested. As I'm speaking to you, more than 2/3 of the average American family's net worth is locked inside a single asset, their home, according to the Federal Reserve's own survey of consumer finances. One price, one market, one assumption that housing is stable. History shows that assumption has failed every time leverage reached this level. And today, leverage is everywhere, even if you can't see it. This isn't about irresponsible borrowers. It isn't about people missing payments. In fact, that's what makes this cycle more dangerous than 2008. Most homeowners are still paying on time. The threat isn't default. The threat is liquidity, and liquidity is already thinning. Since 2020, the total size of the U.S. mortgage market has grown to roughly $12 trillion, driven by ultra-low interest rates and aggressive credit expansion, confirmed by Federal Reserve flow of funds data. That growth didn't come from rising wages or productivity. It came from debt. Cheap debt. And cheap debt always creates expensive consequences later. Between 2020 and 2023, national home prices surged close to 40%, according to the S&P CoreLogic Case-Shiller Index. That kind of appreciation has only appeared a handful of times in modern U.S. history. And every single time, it reversed. The reason is simple. Prices can rise faster than incomes only temporarily. Eventually, the buyer disappears. By late 2024, the Atlanta Federal Reserve's Homeownership affordability monitor showed that the median U.S. household needed to spend over 40% of gross income to afford the median-priced home. The long-term sustainable level is about 25%. That gap isn't a warning sign. It's a structural failure. Markets don't correct when people feel nervous. They correct when buyers mathematically no longer exist. And while the public focuses on inflation headlines and interest rate debates, something far more important has been happening quietly in the background. Banks, institutions, and regulators have been repositioning, not announcing panic, preparing for stress. In late 2024, multiple global banks disclosed losses tied to real estate-linked derivatives, including Deutsche Bank, which reported over $1 billion in losses connected to property and interest rate exposure. These weren't defaults, they were early stress fractures, and in finance, losses always appear before failures. At the same time, the Federal Reserve dramatically increased its involvement in mortgage-backed securities markets, absorbing hundreds of billions of dollars in agency MBS to stabilize prices. That isn't routine support, that is intervention. Central banks don't step in when markets are healthy. They step in when private buyers disappear. This pattern isn't new. It's old, older than the Federal Reserve itself. In the 1920s, Americans believed real estate could never collapse nationally. When the Florida land boom imploded in 1926, it was dismissed as a regional problem. 3 years later, the banking system cracked. By the time the stock market collapsed in 1929, hundreds of banks had already failed, poisoned by real estate debt they quietly carried on their balance sheets. Homeowners didn't lose their houses immediately. Many lost them years later when banks needed liquidity and called in loans early. History didn't save them. Proximity to collapse destroyed them. The same structure appeared again in the 1980s during the savings and loan crisis. Deregulation allowed institutions to gamble depositor money on commercial real estate. Vacancy rates soared. Regulators knew years in advance. They delayed. When the system finally snapped, over 1,000 institutions vanished, and mortgages were sold to aggressive servicers. Foreclosures followed, not because families changed, but because ownership of debt changed. Then came 2008, the collapse most people remember, still misunderstand. It wasn't caused by homeowners, it was caused by leverage layered on top of leverage, amplified by derivatives, and justified by the belief that risk could be mathematically erased. When confidence vanished, liquidity vanished with it. Within 2 years, tens of millions of Americans lost their homes, not because they were reckless, but because the system was structurally fraudulent. What matters is what happened after. The debt wasn't destroyed, it was transferred. Interest rates were pushed to zero, trillions of dollars were created, and the largest share of that liquidity flowed straight back into assets, especially housing. The bubble didn't die, it grew larger. Now, 16 years later, the system is heavier, more leveraged, and more interconnected than ever before. As of 2024, more than $1 trillion in commercial real estate loans are scheduled to mature by the end of 2026, according to banking and regulatory filings. Office vacancy rates remain elevated across major U.S. cities due to permanent shifts in work behavior. Many of these buildings cannot be refinanced at current interest rates without massive losses. When those losses materialize, they won't stay contained. They never do. Regional banks are especially exposed. They hold a disproportionate share of commercial real estate debt while also servicing residential mortgages. This matters because when one side of a balance sheet breaks, the other side tightens. Lending standards rise, refinancing options disappear, liquidity drains. And behind all of this sits the most fragile structure in modern finance, the derivatives market. According to the Bank for International Settlements, global notional derivatives exceed $600 trillion, with U.S. banks holding enormous exposure to interest rate and credit swaps tied directly and indirectly to real estate. These contracts function on trust. As long as everyone believes everyone else can pay, the system holds. When that belief cracks, it collapses instantly. That's exactly what happened in March 2023 when Silicon Valley Bank failed in less than 48 hours, despite passing regulatory stress tests weeks earlier. The failure wasn't about bad loans. It was about speed. Digital withdrawals move faster than regulation. Trust disappears faster than policy can respond. And that's the lesson most homeowners still don't understand. Housing doesn't collapse when people stop paying. It collapses when credit stops flowing. When refinancing shuts down, prices stop being theoretical. Zillow estimates stop mattering. The only price that exists is the price a buyer with financing can pay. When buyers vanish, prices gap down, not slowly, but violently. That's the phase we are approaching now. This isn't fear, it's sequence. In the next part, we'll identify which segment of the housing market breaks first, the single banking signal that confirms the cascade has begun, and why millions of homeowners will discover too late that their biggest asset was never really theirs to begin with. Because in every financial collapse, wealth isn't destroyed. It's transferred. On a normal weekday morning in mid-2025, you won't see panic. There will be no sirens, no breaking news banners, no officials standing behind podiums. The first real signal won't come from housing prices or unemployment numbers. It will come from banks quietly doing nothing. Loan approvals slowing, refinancing taking longer, credit lines being temporarily reviewed. That's how every cascade begins, not with noise, but with hesitation. By the time the public notices, the system has already decided who survives. The reason is simple and uncomfortable. Housing doesn't collapse when people lose jobs. It collapses when credit disappears, and credit disappears long before headlines change. Right now, the U.S. market is supported by one fragile assumption that mortgages will always be available. According to data from the Mortgage Bankers Association, over 90% of home purchases in the United States require financing. Cash buyers are the exception, not the rule. Remove credit and demand doesn't weaken. It vanishes. That's not theory. That's arithmetic. This is where commercial real estate becomes the spark everyone underestimates. As of late 2024, banking and regulatory filings show more than $1 trillion in U.S. commercial real estate loans maturing before the end of 2026. Office buildings are the epicenter. Vacancy rates in major metro areas remain historically elevated, driven by permanent shifts toward remote and hybrid work. Many properties generate insufficient cash flow to refinance at current interest rates without massive write-downs. When refinancing fails, defaults rise. When defaults rise, banks absorb losses. When banks absorb losses, they tighten lending everywhere. This is not speculation. It is already happening. Regional and mid-sized banks hold a disproportionate share of commercial real estate exposure while simultaneously servicing residential mortgages. When losses appear on one side of the balance sheet, the response is predictable. Lending standards tighten, appraisals become conservative, approval timelines stretch, home equity lines are frozen or reduced. These actions rarely make headlines, but they reshape the market faster than any price chart. We saw this exact mechanism in March 2023. Silicon Valley Bank did not fail because borrowers stopped paying. It failed because confidence evaporated and liquidity moved faster than regulators could respond. Within days, other institutions followed. The lesson wasn't that regulation failed. The lesson was that speed has changed the rules. Digital withdrawals, instant transfers, and real-time risk awareness compress timelines that once took years into hours. Housing markets operate on the same fragile trust. When banks sense counterparty risk, not defaults, just risk, they protect themselves. They don't announce it. They quietly retreat. And when they retreat, homeowners lose options before they lose equity. That's why price declines always lag credit contraction. By the time prices start falling visibly, the damage is already locked in. The next phase unfolds mechanically. As commercial real estate losses accelerate, bank capital ratios tighten. Institutions respond by reducing exposure to anything perceived as non-essential risk. First-time buyers are hit hardest. According to government-backed mortgage data, a majority of mortgages issued since 2020 went to first-time buyers, many with minimal down payments. These borrowers entered at peak prices with little margin for error. A modest price decline erases equity. A moderate decline traps them. At the same time, corporate ownership of single-family housing has increased materially since 2019. These entities do not behave like households. They are fiduciaries. When markets turn, they do not wait. They liquidate. That behavior accelerates supply exactly when demand is weakest. This is where time compresses. Once prices begin falling, refinancing shuts down completely. Homeowners who plan to reset adjustable rates or extract equity discover those options no longer exist. Delinquencies rise not because people suddenly become irresponsible, but because the financial bridge they relied on disappears. Foreclosures follow with a lag. Inventory rises into a shrinking buyer pool. Prices gap lower. This is the cascade. And layered on top of all of this is the most fragile structure in modern finance: derivatives. According to the Bank for International Settlements, global notional derivatives exposure exceeds $600 trillion, with U.S. banks holding enormous positions tied to interest rates and credit. These instruments are not inherently dangerous. They become dangerous when counterparties doubt each other's ability to perform. When one institution fails to meet a margin call, trust evaporates. Trading halts, liquidity freezes. This is exactly what happened in 2008. Lehman Brothers did not collapse because mortgages defaulted overnight. It collapsed because no one would transact with it anymore. Counterparty risk killed liquidity, and liquidity is oxygen. In late 2024, Deutsche Bank disclosed significant losses tied to real estate-linked derivatives. Not defaults, losses. That distinction matters. Losses are manageable until they aren't. Losses become systemic when confidence breaks. These disclosures were not headlines. They were signals. At the same time, central banks quietly increased intervention in bond and mortgage markets to stabilize pricing. This is not routine policy. Central banks do not become buyers of last resort when markets are healthy. They intervene when private capital steps away. And private capital steps away when risk can no longer be priced. This is the moment most homeowners misunderstand. They believe government intervention guarantees safety. It does not. Intervention protects systems, not individuals. It preserves banks, not balance sheets. It ensures transactions continue, not that prices remain high. History is unambiguous on this point. In the early 1930s, homeowners who made every payment still lost their houses when banks needed liquidity. In the savings and loan collapse, mortgages were sold and terms enforced aggressively. In 2008, millions were foreclosed on despite government programs because the scale overwhelmed the response. Bailouts slowed collapse. They did not prevent transfer. And the scale today is larger. Federal debt exceeds historic norms. Central bank balance sheets are already expanded. Political tolerance for widespread homeowner bailouts is limited. Even if intervention occurs, it will prioritize systemic stability over individual outcomes. That means the adjustment will express itself where it always does, through prices, access, and time. Homeowners will not wake up to a single catastrophic announcement. They will wake up to fewer options, fewer approvals, lower appraisals, longer timelines, higher scrutiny, and eventually forced decisions. This is why the myth that housing only crashes when people stop paying is dangerous. People stop paying when choices are removed, and choices are removed by credit contraction, not personal failure. The uncomfortable truth is that housing is not just shelter, it is collateral. And when collateral values fall inside a leveraged system, the system responds automatically. It does not care about intent, effort, or history. It cares about balance sheets. That's why millions of homeowners will discover, or too late, that their largest asset was also their largest exposure. The cascade doesn't need everyone to fail. It only needs enough pressure at the margins to force selling. Once that starts, prices adjust downward until liquidity returns, and liquidity returns only when fear is exhausted. In the next part, we'll identify the 3 specific markets that historically break first, the one banking signal that confirms the cascade is irreversible, and the single asset class that has consistently preserved purchasing power when housing collapses. Because when this phase becomes obvious, preparation will no longer be an option. And in every financial crisis, wealth is not destroyed. It is transferred. By the time the average homeowner realizes what's happening, the market will already be closed to them. Not literally closed, just unavailable. That's how financial endings work. Doors don't slam shut. They quietly lock, and the people inside only notice when they try to leave. The final phase of every housing collapse is not defined by falling prices. It's defined by disappearing choices. This is the part history repeats with brutal consistency, and it's the part most people never see coming. When credit contraction reaches a critical threshold, banks stop behaving like lenders and start behaving like survivors. Approval standards tighten overnight. Appraisals come in lower than expected. Refinancing requests are delayed, then denied. Home equity lines are reduced or frozen entirely. These actions don't make headlines, but they change everything. Because modern housing markets do not function on ownership, they function on financing. According to the Mortgage Bankers Association and Federal Reserve data, roughly 9 out of 10 U.S. home transactions depend on mortgage credit. When that credit hesitates, demand doesn't slow, it collapses. Buyers disappear first. Prices follow later. This is why waiting for price signals is always a mistake. Prices are the echo, not the event. As commercial real estate losses continue to surface, regional banks face an unavoidable problem. Their capital ratios are squeezed from 2 directions at once. On one side, office buildings and retail properties are being repriced lower due to refinancing failures and elevated vacancy rates. On the other side, residential mortgages are marked against declining collateral values. When this happens, lending isn't reduced gradually, it's pulled back defensively. This is exactly what happened during the savings and loan collapse, when more than 1,000 institutions vanished and mortgage servicing was transferred to entities that had no incentive to negotiate. It's what happened in 2008 when banks passed stress tests yet failed within weeks because liquidity vanished faster than regulation could respond. And it's what we saw again in 2023 when Silicon Valley Bank collapsed in under 48 hours, not because of loan defaults, but because trust evaporated. The final warning signal is never a headline. It's a freeze. When banks stop lending to each other even briefly, the cascade has already begun. Interbank hesitation is the financial equivalent of oxygen loss. According to historical data from the Federal Reserve and the Bank for International Settlements, every major financial crisis of the last century was preceded by stress in short-term funding markets. This is where derivatives magnify damage. Global derivatives exposure exceeds $600 trillion in notional value, as reported by the BIS. These contracts depend on counterparties meeting margin requirements daily. When asset prices fall and volatility rises, margin calls increase. If one major institution struggles to post collateral, others pull back instantly. Trading halts. Liquidity evaporates. This is not theory. This is how Lehman failed. This is how Bear Stearns collapsed. This is how systemic crises propagate. In late 2024, Deutsche Bank disclosed significant losses tied to real estate-linked derivatives. Again, not defaults. Losses. But losses are how cracks announce themselves. Defaults are how walls fall. Once this phase is reached, the housing market enters what economists politely call price discovery. In reality, it's forced liquidation. Sellers are no longer setting prices. Buyers with financing are. And when financing is scarce, prices fall until capital returns. Historically, that adjustment ranges between 20 and 30% nationally, deeper in overheated markets where speculative demand dominated the previous expansion. This is the moment when millions of homeowners discover a truth that feels personal, but isn't. They didn't fail, the system moved, their house didn't become worthless, it became illiquid, and illiquidity is fatal in a leveraged environment. The idea that governments will simply step in and prevent this outcome misunderstands how intervention works. In every crisis, intervention targets plumbing, not people. It stabilizes payment systems, not purchase prices. It protects banks so transactions can continue. It does not guarantee that asset values remain elevated. In 2008, despite unprecedented bailouts, tens of millions of Americans lost their homes. In the 1930s, foreclosures surged years after the initial collapse as banks called in loans to survive. In the S&L crisis, homeowners paid the price for institutional failure. There is no historical precedent for a debt-driven housing bubble unwinding without transferring ownership away from those who relied on leverage. This is where the final transfer occurs. Households that purchased at peak valuations with minimal equity buffers are forced to sell or default. Corporate and institutional buyers with cash step in later after prices reset. This is not accidental. It is structural. Liquidity always buys from leverage. It has never worked any other way. And this brings us to the final question everyone asks too late. What survives when housing doesn't? History gives a clear answer. The assets that preserve value during housing collapses are not speculative. They are liquid, unleveraged, and boring. Cash equivalents, short-term government securities. Assets that do not require refinancing to exist. During every housing downturn of the last century, purchasing power migrated away from leveraged real assets and toward liquidity. That doesn't mean fortunes are destroyed. It means they move. The tragedy is not that this happens. The tragedy is that it is predictable, documented, and repeated, yet still ignored. In the 1920s, people believed land could never fall nationally. In the 1980s, they believed deregulation made banks stronger. In 2006, they believed housing never goes down. In 2024, they believe central banks can control outcomes. They can't. They can slow events, they can shape narratives, but they cannot repeal math. When debt servicing costs exceed economic reality, leverage unwinds. When leverage unwinds, ownership changes. And when ownership changes, those closest to liquidity survive. This is not a warning meant to scare you. Fear is useless. This is a map, a sequence, a cycle that has played out across centuries, currencies, and political systems. Fortunes are not destroyed in financial crises. They are transferred from those who believed stability was permanent to those who understood it never is. And once this phase begins, the only thing that matters is whether you recognize the pattern before the door's quietly locked. Because when the system chooses who survives, it doesn't ask who deserves it. It asks who is liquid. By the time most people realize what just happened, the story will already be written, not in headlines, but in balance sheets, not in panic, but in silence. Financial systems don't collapse loudly. They resolve quietly through ownership changes that feel personal, but are never personal. This is why history keeps repeating itself. The language changes, the technology evolves, but the cycle stays the same. Leverage expands, confidence hardens, liquidity thins, and then suddenly choice disappears. Not because people were careless, but because the system reached its limit. For those who saw the pattern early, this moment won't feel chaotic. It will feel familiar because every major financial shift of the last century followed the same path. And in every one of them, wealth didn't vanish. It moved. That's why conversations like this matter, not to spread fear, but to restore perspective. Understanding how the system works doesn't guarantee safety, exposure. If this breakdown helped you see the housing market differently, share it with someone who still believes prices alone, tell the story. Most people won't hear this until it's already behind them. And if you want to stay ahead of the next shift, the signals the headlines miss, the patterns, history keeps repeating, subscribe to the channel. Because when the cycle turns, information doesn't disappear. It just becomes expensive.